And I can't tell you how important that piece of advice is. In fact, this is probably the most important piece of advice that they got. How did two 20-year-old college dropouts with no money, no experience, and no jobs build a 28-unit, $2.3 million real estate portfolio in just 2 years? Well, that's the story of Caleb Hummel and Chuck Sotelo, and I've narrowed down their success to just 5 key points. And I'm going to show you exactly how they did this without putting up any of their own money and without doing anything illegal. Because quite often, when you see success stories like this, it's easy to assume that there was a little bit of underhandedness, and that just simply isn't the case. But what is true about their story is that they were able to find a way to strategically go out and purchase real estate in a manner that not only reduced their risk, but also allowed them to build a really big portfolio really fast. But before we get into the details, my name is Noel Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. Okay, so let's get right into this and talk about the setup, how they made this happen. And first and foremost, it all starts with a little book called Rich Dad, Poor Dad, which actually seems to be the case for a lot of people who decide that they don't want to live in the normal 9 to 5 world and they want to be investors. And I myself am one of those people who's read a lot of Richard Kiyosaki books, and just like Caleb and Chuck, they inspired me to invest in real estate. And for these two 20-year-olds, they actually started around the same age that I did. However, they did it at a much bigger scale. And that's what I found so interesting about their story when I was cruising through Business Insider. And yes, I'm one of those real estate nerds who pays for the premium membership of Business Insider just so I can see the real estate stories. But what makes it amazing that they were able to do this at this big of a scale is that they had no experience, they had no jobs, they had no money, which are three of the things that are typically required in order to invest in real estate. So in order to get the first thing that they needed, which was some knowledge and some experience, they started hanging out at real estate investing meetups. And at some point, somebody referred them to a mentorship program, and that mentorship program set the tone for what was about to happen. Now, as a mortgage professional, as a lender, we typically hate it when people go to these courses because they tend to come back with unrealistic expectations about what's possible. And that's commonly in the form of not wanting to do the hard work or wanting to do things that are technically not legal. And let's call a spade here. Anything that's a misrepresentation, an omission, or a flat out lie is mortgage fraud. And more often than not, we find people who take real estate education courses are taught things that put them in the gray area or sometimes even in the black area of what's right and wrong. But somehow these two managed to figure out what was right and wrong, what was legal and what wasn't, and figured out a way to purchase real estate, which isn't really interesting, and I'll get to that in a second, that put them in the white hat area of how to purchase real estate and not do it illegally while also using other people's money. So once they started what seemed to be a very good education process when it came to investing in real estate, they realized that the first steps that they needed to take was to find a market to invest in. Now, these two guys live in San Diego, one of the most expensive real estate markets in North America, and a market that just is not in general super good for first time investors. Now, I was always taught that you only want to invest in markets that you know and that you live in so that you're close to the properties in case anything goes wrong. But what I've been noticing as I'm doing more and more research on real estate investing, especially with millennials, is that there is a tendency now with technology to be able to purchase property in other areas and still be able to monitor it and manage it fairly easily. So these guys looked at several different places, and in my research, I determined that they looked at places like Reno, Nevada, as well as Texas, and ultimately decided on purchasing properties in Texas. And they outlined two criteria that were important to them. First was a market that is growing, and second is a market that is favorable to landlords. So in other words, they wanted to purchase in places that encouraged real estate investment and also didn't have things like rent controls. Because if you're a landlord and you live or buy in a market that has rent controls, that can be one of the most challenging things to face, especially in times like now where costs are going up on everything, but rent controls are making it so that you can't increase rents to keep up with those costs. Now, once they'd picked their market, they needed to find the property. And for these guys, they were going to have to be unconventional both in their purchase and in their financing. Because, like they said, who's going to lend a whole bunch of money to two 20-year-olds who are trying to purchase 10-unit buildings at close to $1 million a piece? So these guys rolled up their sleeves and started doing the hard part of real estate investing. And that's the actual work. And they realized that they were going to have to make a lot of phone calls. They were going to have to talk to a lot of sellers in order to find exactly the right seller for them. And why was finding the right seller so important? Well, because they needed the seller to be on board to finance the property for them. because they weren't going to get the money from the bank, not only from an experience perspective, but also from a financial perspective. And on top of that, they plan to use other people's money, which is pretty much a non starter for any bank. Now, just so you know, when you start doing real estate deals and you want to use other people's money, so in other words, you want to bring in investors for the down payments, as soon as you typically disclose that to the lenders, it's pretty much a full stop. Banks want to see borrowers actually putting up their own funds so that they have some skin in the game. Now, there is a certain amount of leeway for this, but for the most part, and especially for two 20-year-olds, basically saying, hey, we're buying this $1 million property and we are also going to get these people to provide the down payment was going to be a non starter. So they needed seller financing. And that was about the only legal way I can think of for them to structure these deals. So what that meant is they needed to find sellers who had owned properties for quite some time, had free and clear titles, and that were just not interested in having to manage them anymore, but still wanted some of the investment returns without having to do the work. And the way you find those sellers is simply kissing a lot of frogs. And in one article that I found, it was suggested that they made up to 500 phone calls to find the first property. Now, the thing about doing seller financing is that instead of having certain rules that you have to follow with the bank, you basically get to make up the terms yourself. So anything that the seller and you are willing to agree to becomes the terms of your financing. So this meant that they could go and get the money from other people. They could do things like ask for 6 months of no payments in order to build up cash flow reserves, and they could limit their personal liability by not signing personal guarantees for the financing. Now, essentially what they were doing was they were making the sellers a partner in their business, because even though the arrangement was a financing arrangement, they still had certain obligations to the sellers, which basically made them business partners. And the nice thing about that is for the seller, they want to make sure that the buyer is successful because obviously they're holding the mortgage. And vice versa, the buyer wants to make sure that the seller is happy because they are the ones that are providing the financing. So this type of deal is typically structured as a win-win for both parties. The seller continues to get to have some returns on the property that they spent the last 20 to 30 years paying off, and the buyer gets to take over that property even though they may not qualify for normal financing. Now, that leads us to the down payment, because the down payment was gathered by doing a capital raise. And on their very first deal, which by the way was a $900,000 property that had 10 units, they needed a 10% down payment. Again, the nice thing about doing seller financing is you can agree to whatever terms you want, and in this case, they agreed to a 10% down payment, which was significantly better than what these two buyers would have needed if they had gone to the bank for financing. Now, on this first deal, they ended up with 3 investors at $30,000 each. Now, more than likely, these were family members or people that they already knew, but on this first deal, I'm guessing these were people that were very close to Caleb and Chuck. And the nice thing here is if you can get that first deal done, it makes the second and the third and the fourth that much easier. Because once you're able to prove that you've already done one of these transactions, then you can go to other sellers and say, hey, we've got experience, and that helps with the buy side. And you can go to investors and say, hey, we've got experience, and that helps with capital raisers in the future. Now, in the case of this first deal, they offered anybody who was an investor an 8% return on their money, and also included a clause to allow them to buy out the investors at a certain period of time. Now, my guess is the strategy here is after a year or 2 or 5 years, they're going to go and find conventional financing, refinance these properties, and then pay out those original investors. And the nice thing about that is they'll essentially be able to have purchased these properties with none of their own money. They're going to build a substantial amount of equity. They're going to have to do a lot of hard work, but as long as they're in this for the long game, they've set up the foundations for success of what could be a really big empire somewhere down the road. Now, once they had structured this whole thing, they had gotten their education, they had picked their market, they had found their sellers, got their creative financing, and done their capital raise. Well, after that, it was simply a matter of going and rinsing and repeating. Find another seller, structure the financing, and then go out and find the investors. And one of the best pieces of advice that they got from their mentorship program was to find the deal first and then worry about the financing after the fact. And I can't tell you how important that piece of advice is. In fact, this is probably the most important piece of advice that they got, was to find the deal and then figure it out from there. Because what we often see with new real estate investors or new realtors or new mortgage brokers is they want to spend all of their time getting educated so they know as much as possible, and they never actually go out and find their first deal. And then even if they do find their first deal, they realize that they don't know much and that the real education is in the actual doing, not in the learning. So for Caleb and Chuck, they went out, found their deal, and then got a really fast education that allowed them to do this 2 more times. And the properties they ended up purchasing were the first one, which was a 10-unit building at $900,000, the second one, which was a $700,000 building with 8 units, and the third, which was a $725,000 building with 10 units. And my guess is that they'll continue to rinse and repeat down the road as they find more properties that make sense and as they find more investors that are willing to invest in their real estate company. Now, as a quick note, depending on where you live, there are certain rules with respect to selling securities, so you have to be very cautious about going out and finding investors. It's not as simple as putting up a Facebook ad or doing a video and saying, hey, come invest in my property, because if you do stuff like that, you can breach securities laws, especially if you don't know the people that are investing. So it's best to start small and with people that you have existing relationships with. And you'd be surprised how many people there are with money who want to make investments in real estate but don't want to do the work. So if you can be the person who's willing to do the work, finding the money is actually typically a lot easier than you'd think. Now, obviously, there's a whole bunch of different ways to invest in real estate, and this is by far not the only one. If you want to see another example of a 25-year-old who built a $9 million portfolio in one of the most expensive real estate markets in the world, make sure you check out this video right here. And by the way, he didn't do it using other people's money. He did it by saving the down payment himself and getting some conventional financing and some creative financing as well, albeit a slightly different type. So make sure you check out that video too.